If you're hunting for the lowest interest rate, you're already making your first mistake. The cheapest loan isn't always the smartest one. What really matters is how your mortgage is structured, because that's what can save or cost you thousands later.
We're talking with a mortgage strategist, Stuart Wemyss, this week, and he's going to break down for us exactly what first home buyers get wrong so often. So before you sign anything, listen to this episode. It's called Mortgage Strategy for First Home Buyers, because it's not just about getting a loan, it's about getting it right to set yourself up for the future.
Welcome to Your First Home Buyer Guide, the podcast for first home buyers who want to feel confident, smart and totally in control of their property journey.
I'm Veronica and that was Meighan, and yes, we're probably old enough to be your mums, which is a good thing because between us we've got decades of experience and we've got your back every step of the way. Our mission, to cut through the BS, keep it real and make sure you're buying smarter, not stressing harder.
Quick heads up, we've created the First Home Buyer course, our step-by-step program to help you buy your first place with confidence and without the costly mistakes. The link's in the show notes, but stick with us first. You'll want to hear this episode.
Today we're diving into one of the most misunderstood parts of the buying process, your borrowing strategy. Now this sits right inside step 2, money, in our PACE system. Remember, that's preparation, action, commitment, execution. There's 10 steps in there. You get them in the right order and your home buying process will be so much easier. But step 2, money, is one of the most critical foundations really to get it right before you even start looking at property. So we are thrilled to welcome back someone who's no stranger to the podcast, financial advisor, mortgage strategist and all-round money guru, Stuart Wemyss. Nice to see you again, Stuart.
Oh, thanks for the invite. I enjoy talking about property. I enjoy talking about finance. So always a pleasure.
It is great to have you back here again, Stuart. I had a little sneaky peek, and actually the last time we had you on the podcast was 2021, episode 28. And of course, we have seen each other a lot in that interim period. We do a lot of business with your clients and help each other out. So it's not like we haven't talked to you in all that time. We just haven't shared you with our listeners.
Yeah, wow. It shows time flies, doesn't it? It's probably all the emotional turmoil from COVID. You know, you just sort of block out those years and they're the missing years, if you like.
Borrowing strategy, it sort of gets thrown around a little bit. Some people might not have even heard about it, but most first home buyers think they just need to go out there and find a bank with the lowest rate. Can you actually define what borrowing strategy is for our listeners and why it is so important to get it right from the start?
So I think it's as important as asset selection. So that is buying the right property. And the reason that I say that is that your borrowing strategy will dictate at what quality asset you can buy, when you can buy it, and also then when you can add to your property portfolio. And the answers to those questions are pretty dramatic. If you can afford to move into a different price bracket and get a better quality asset initially, if you can afford to get into the market now rather in 12 months' time, and if you can afford to add the second property a year sooner than you otherwise would, all those things are going to compound over a very long period of time. Plus also, asset selection is a one-off decision into, I will buy this property. Now, of course, we've got to think about how can we improve the property and add value and improve its income stream, all those sorts of things. But really, finance as a strategy is an ongoing process. And so I would argue asset selection is really critical, 100%. I don't want to take away from that. But I would say that finance strategy is on equal footing. So there's a lot that goes into a finance strategy, how to make finance tax effective, how to safely maximize your borrowing capacity, how to utilize equity that you have in existing property to work really hard for you. All those things are interrelated and into a finance strategy. And then the cost of finance, being the interest rate, is only a small subset of that, but it's not a deal maker or breaker. You know, if I can save 0.5%, that's great, but not if it comes at a cost of all those other things that I just spoke about.
It's fascinating because, you know, we do start with, particularly first home buyers, they just think about getting into the market and they're also thinking about the cost of doing so. It's costly to save up. It's also costly to have a mortgage for the first time. But what you're saying there is really not just about getting the loan. It's really about setting yourself up so you can use the first loan right and well over time. And it's an active strategy by the sounds of it. So it's something a lot of people don't realize. Which sort of does bring me to the next point, that everybody is obsessed with interest rates. I mean, we're recording this the day after Melbourne Cup. That's the day the RBA sits, and they didn't reduce nor increase rates. But every ad, every online comparison site, every friend, barbecue chat, you see about who got the cheapest rate. So why isn't the rate the thing we should be focusing on? Why isn't 0.5% that material?
So I cast my mind back to the first property that I bought, and it was a long time ago, 25 years ago. It was before mortgage brokers were really a thing. And I banked with CBA at the time and just spoke to them, and they said, that's my borrowing capacity. But actually, if I had shopped around at that time, I probably could have made a better property decision in hindsight. Now, I didn't know what I was doing back then. Hopefully, I know a little bit more today. But so for first home buyers, the first property they buy is, I would say, one of the most important financial decisions they will make in their lifetime. And I know that sounds like hyperbole, but it really is, because if you make a fantastically smart decision, it will compound dramatically almost through the rest of your life. Whereas if you completely mess it up, it'll be an anchor for you for the next 10 years. And so buying the right asset in terms of the highest quality asset, all the things that you ladies talk about, really is dictated by my budget. How much can I spend and when can I enter the market? Well, that's all dictated by borrowing capacity. So I would say this, if I could speak to myself 25 years ago, the thing that I would say is, Stuart, don't give a shit about interest rate. Just find the lender that best suits your circumstances, allows you to utilize whatever deposit and borrowing capacity you have to its fullest potential in a safe way. I'm not saying go out and just mindlessly borrow, to your eyeballs. Of course, you need to be prudent about these things, but if then allows you to buy a better quality asset or the same quality asset sooner, you're off to the races. And at the end of the day, the reality is you're probably not going to pay that much of a higher interest rate. If I put a circle around the top 10 lenders, the difference in interest rates will probably be less than 10 basis points, 0.1%. But the difference in borrowing capacity, loan terms, all those sorts of things are going to be vastly different. And that's the thing that's going to separate it. So interest rate, if I was a first home buyer, would be the last question I would ask.
Oh, such good advice. And I guess what you're really telling us there is that focusing on interest rate alone or as a primary driver is really short-term thinking. And that's not property. Property is not about short-term thinking. So people might save a few bucks now, but actually pay for it later when their structure doesn't let them make the next move. And I think, you mentioned it earlier, that it's setting yourself up for not just this purchase, but whatever it is that your plan into the future looks like. Now, you've probably seen hundreds, maybe thousands, I don't know, first home buyers come through your business and your associated business partners over the years. What are some of the avoidable mistakes you see them make when it comes to their loans or their approach to borrowing money?
So, interest rate is a good starting point because I get the tension. The tension is the first home buyers typically aren't starting from a hugely strong financial position, and every sort of monthly commitment makes a big difference to them and dramatically impacts their life. So I get that there's a natural tension there for them to think about, well, if I can minimize the interest rate, that becomes more affordable and I need to make fewer sacrifices potentially. So I get that, and I think that message has some common sense. The problem is, at what cost is you need to ask, and that's what I'm trying to get across. Look, I think probably the biggest mistake is that people don't think about what next, right? When they first buy their property, what I would be thinking about if I buy my first property, if I'm of a mind to build wealth, and that's why I'm buying property, I would think about how does this first property actually get me started on the property ladder, and how does it help me buy the second property and third property, rather than just focusing on this property. And that's what we will talk to clients about. Okay, yes, but how will you live in it? How long will you live in it? Is it for your ever home? Where do you want to end up? What do you think is going to happen with your income profile? Do you want to get married? If you get married, are you going to have kids? All these sorts of things start to build out a bit of a picture, and it sort of informs and gives context for making a decision today. Because how we structure the mortgage today, we're going to have to live with for really the entire time we're going to own that property. And our life circumstances are probably going to change over that period of time that we own that property. So let's make sure that whatever we're doing today, that we're not going to regret later on. And probably the biggest mistake I've seen is set the loan up as principal interest and aggressively repay the loan so that you're getting rid of the debt. And that might suit some people, but I would say probably the vast majority of young people, that's probably the worst move that they can make because they're reducing their flexibility.
That is interesting because it's often grandparents' advice, isn't it? Because that's what they did.
Yeah, and they think, it makes sense. You're reducing the interest bill, you're owning more of the property, you're building financial security. I think that there's a whole bunch of reasons why you might do that, but there's even better reasons why maybe that's not the right approach. And they're linked to, well, what happens when you want to utilize the equity in that property? How are you going to make that debt as tax effective as possible longer term? All these sorts of things. And I think by having a bit of a longer term plan gives you some context to make decisions today. Now, that's difficult if you're in your 20s and you're going out and buying your first home or early 30s. A lot can change over the next decade, but you just broadly want to know, okay, I'm going to get a foot in the door. I know I want to live in a certain area. I know I want a house and buy an apartment. And it starts to build a little bit of a picture. So you don't necessarily need to be able to predict the future perfectly well, but you need to have some consideration to the future and ask yourself, how should that inform my decision making today?
So one of the things that I think about too is that a lot of first home buyers go to a broker and they're thinking, I want the cheapest rate. We've talked about that. The other thing that they may or may not be thinking, and sometimes brokers will bring this up, and that is, this is how you access all the grants. So can you talk to that a bit? Because that can be good money or bad money, can't it?
Yeah, it can. Look, typically as a general rule, I would say to first home buyers, go position yourself so that you can borrow enough to give you indigestion. It's got to, that first property purchase has got to make you sick. And if it makes you sick, you're probably doing it right. Now, people can take that the wrong way. I'm a relatively conservative person. Actually, if I think back to the property transactions that I've entered historically, I would go, if I could speak to myself then, I would go, look, go a bit harder, Stuart. It's always going to work out. So I'm not being flagrant about it, but really it's about quality of asset. And it's about sometimes an extra, well, you guys would know this, an extra $50,000, $100,000 can get you into a different street or a different part of the suburb, different type of asset. And that can make a much, much bigger difference than that small incremental change of $50,000 in terms of serviceability. So really the main aim, if I was speaking to, my son's only 18, they're not buying property yet, but if I was speaking to them, I would be saying, find the lender, let's find the lender that's going to give you the most amount of money, that's going to lend the most amount of money to you. And then let's compare its interest rate to the lender that's the cheapest. Let's make sure there's not a huge gap there. It's not going to be. It's not going to be 1%. As I said, it's probably 0.1%. And let's make friends with that gap. And let's then understand what that extra capacity gives you in terms of purchasing power and the quality of that asset and what the outcomes might be longer term. That's the number one thing I would focus on now, if it had an offset account, that'd be great, but I'm not worried about
Can you just really briefly describe to people what that is, just in case it's a new concept? What is an offset as opposed to paying more off your property, and how can that be useful?
So when we first buy it from a taxation perspective, and whilst we might be buying, and quite often first home buyers, it's their first home, right? They're going to occupy the property. That's great, but it's probably not their forever home. And so what they want to think about is when they make their next property move, will they keep the existing property or sell it? Now, they might not know the answer to that, but what they should be thinking about, what happens to the debt if I keep it? And can we make that as tax effective as possible? So from a taxation perspective, how you pay for the property initially, you have to live with for the time that you own that property. So if I go and buy a property for $100,000 and I put in $30,000 of my own money and borrow $70,000, and then in 2 years' time I think, oh no, that was a mistake, I should have borrowed $80,000 or $90,000, I can't go back and increase the loan because the tax deductibility is linked to the purpose. So the purpose of what I use those extra funds for will dictate whether it's going to be tax deductible. So what a much better approach is for me to initially borrow the $90,000, put in $10,000 on my own money, and then the $20,000 I've got left of savings, I'll put into an offset account. And an offset account is just a transactional account. And when they calculate the interest that I owe them on the mortgage every day, at the end of every day, they will net the two amounts off. So I've got a $90,000 loan, $20,000 in my offset account. I'll pay on that day interest on $70,000. So I'm still minimizing my interest, but the key thing is that I'm setting the maximum future tax deductible loan when I first purchase purchase the property. And that's something I've got to be really careful about, because if it does ever become an investment property, even if you have no intentions of it becoming an investment property today, at least prepare yourself for that potential outcome. And you can still aggressively repay the loan by building the money in the offset account. And it'll still allow you to minimize interest, but you're always preserving the original nature of that tax deductible debt.
Great explanation.
I wanted to talk about rent vesting actually, because it appears becoming more popular amongst first home buyers, living where they want, buying where they can afford. So you just talked about then sort of setting yourself up in case you sort of almost become an accidental rent vestor or an accidental investor. But when you're buying with that full intention, you do have to have a different approach to borrowing, don't you, as opposed to an owner-occupier. And there are some sort of penalties, correct, for investing as opposed to having the intention to live in it. Can you sort of take us through some of that?
So there's two things that are going to impact the potential use of a property: the type of loan product you have and the interest rate that you're going to pay. And that's going to also have an impact on your borrowing capacity as well. Because if I go to the bank and say, look, I'm living at home, I'm paying $100 board, I'm going to rent out the property, from a borrowing capacity perspective, that's probably going to give me more borrowing capacity because I've got rental income, I've got negative gearing to really help me service that debt as opposed to living in it. So sometimes it's necessary for a borrower to approach the bank to say, okay, it's going to be an investment property, so they can maximize their borrowing capacity. The type of loan that I get, whether it's a home loan or investment loan, will have no impact on the tax deductible nature of the debt. And I should say I'm a tax agent, by the way, so I'm not sort of speaking out of school. So people don't need to worry about that so much. So even if I go and buy a property and tell the bank it's going to be my home and get a home loan, and then I change my mind a couple of months after buying the property and put a tenant in it, I can still claim the interest. Even though it might say home loan on the loan, it doesn't matter. It's about the purpose for which those funds were utilised for. The other thing we need to realise is that home loan rates are typically cheaper than investment rates, and that interest-only rates are typically higher than principal interest rates. But it all comes back to the interest rate discussion, right, that we had initially. It doesn't matter. You've got to pick the structure that's going to maximise your future potential outcomes. So even though I might get an investment loan, I might put on interest only, it's going to cost me a little bit more money. I know it's going to help me preserve the original tax deductible nature of the debt, and that's going to give me the maximum flexibility moving forward. But I think about rent vesting, a common strategy or common scenario, I think, for some of our clients is that they will go and buy their first home and occupy it initially as a home. Now, they might decide to do that after settlement. So they might approach the bank and say, look, I'm buying an investment property to extend their borrowing capacity, but there's nothing set in stone, and they might end up changing their mind after settlement and then occupying the property. And so they'll occupy the property for a period of time so that they can claim it as their main residence, and they will need to keep enough records to demonstrate that they've genuinely occupied the property. Things like electoral roll changes, bills in their name, changing the address on your license, all those sorts of things. And you need to keep the utility bills because the state governments have been auditing these things, and they'll ask for water bills, electricity bills to demonstrate you actually occupying the property.
And I guess, Stuart, is that, can I just fill in a little gap there? Is that because often there's a very different stamp duty rate for owning a home versus an investment property? There's also very different grants and time limits that you actually have to be, that has to be your principal place of residence. So quite aside from the mortgage side of things, there are other implications of changing that decision that people really need to look into and get some good advice around.
Yeah, 100%. If you've got a stamp duty reduction or a grant, there's often you've got to live in the property for the first 12 months, or it could be even longer in some states. So they need to think about that. My advice is really just coming from a tax planning perspective, which is a federal government legislation as opposed to state government legislation. And so if they occupy the property initially as their home, and then they might decide to rent vest and rent it out, the benefit of doing that is you have a 6-year window where you can continue to claim it as your main residence, not pay capital gains tax, but you can still get the negative gearing. So it's kind of the best in both worlds. And it suits a lot of first home buyers because it's typically, from a cash flow perspective, better for them to rent the property, particularly if they're still living at home. And that can give them the tax benefits associated with, still having a capital gains tax-free home. Now, of course, you've got to think about, Meighan, as you said, the government grants and stamp duty implications. You might have to occupy the home for the first 12 months in order to satisfy them.
And to keep that exemption, of course, you can't buy another principal place of residence, so you can only claim it on one.
Of course. And if at the end of the 6 years, you can either reoccupy the property and then reset that clock, or if you don't, it just means the capital gains tax bill begins from that end of that 6-year period. So, but it gives the people a lot of flexibility. And I would say most first home buyers are thinking about their second purchase within that 6-year window, and gives people flexibility because they can say, well, the property's done well for me. I don't have enough borrowing capacity to necessarily keep it and buy the next property that I really want. And I've got this window now where I can sell this property and not pay any capital gains tax. And so they keep more of the equity that they get from when they sell the property. So from a strategy, which is kind of what we started talking about at the beginning in terms of how does this fit into my longer term strategy, it can work really well.
Gosh, it's really about being deliberate and getting good advice around this, because sometimes people go, right, I want to buy my first home. That's the strategy. This is what I need to do. I'm going to get the money. I'm going to buy the property. And it's nothing beyond settlement. Like, there's no thoughts of, so being deliberate and getting good advice is incredibly important, because of the structure that works for a rent investor can actually be the exact wrong one for someone who wants to do a stepping stone strategy and live in their own home.
And remember, you're not marrying the lender. I wrote a book called Rules of the Lending Game because it really is a game. Lending is a game. So you might approach lender ABC to initially purchase the property. You're not going to necessarily be with that lender for the next 4 or 5 years. They might be the best to get you in the market. And then after 12 months, you've got a bit of equity, you've got your income's risen, you're in a slightly better financial position. There might be a whole other suite of lenders that are ready to look after your business at potentially a lower cost. So you're not locking yourself in and saying, I'm going to pay this interest rate premium forever. It might be just getting into the market. Like I remember, maybe 15 years ago, I bought an investment property and I ended up borrowing 90% and paying mortgage insurance. And at that stage, mortgage insurance wasn't huge. It might have been like 15 grand. It's a lot more expensive today. I revalued that property about 8 months later after purchasing, and the LVR had reduced below 80%. And so I paid 15 grand to get into the market sooner, to increase my LVR to get into the market sooner. And I don't look at that as a waste of money, because if I had a delayed and bought 8 months later, I would have to pay a lot more for the same property. So that's the thing, is that it's really just about choose a lender that's going to get you to this next step, and then structure that lending so it's going to service you 2 or 3 steps down the track. But it's about a game. This lender, ANZ, might be great for you initially, and then you switch to CBA 2 years later. Just play that game.
It's an interesting point too about, you raise about refinancing, because a lot of people, they do think 30 years, I'm going to be wedded to this thing for 30 years. You're probably not going to own the house or the apartment for 30 years. So therefore, when you sell, you're going to get rid of that loan. But just, do you want to touch on refinancings? Because, like you said, some banks will allow you to get in the market. Maybe you are at a higher interest rate because of that product. But as soon as you're in a better equity position, you can then have options to move. So do you want to just quickly touch on what refinancing is?
Yeah, sure. And that's why I think finance is equally as important as asset selection, because it's something that you've got to continue to play really for the time that you own the property. And I've got a vested interest in saying this because, we started as mortgage brokers, but really a great mortgage broker is your best friend. But also that's just not the magic bullet. You as the client have to keep hustling and pushing that mortgage broker. So it's really refinancing, again, if I'm a first home buyer, is really about maximizing borrowable equity. And the borrowable equity is determined by really 2 things: how a bank will value my property or revalue my property in terms of what amount. And that dictates then how much equity I've got in the property, and then what my borrowing capacity is. So once I'm in the market, I want to be hassling my mortgage broker every 3 to 6 months saying, okay, do you think I should revalue the property? And sometimes, I know personally, I've had a property revalued. One came at 1.2, another one came at 1.5. Same property, 2 different banks, right? Completely different outcomes in terms of borrowing capacity. So valuation shopping, I don't know if that's a good word to use, but the reality is the valuation systems are particularly, reliable necessarily, and the results can be varying. And it just means that if one lender is going to give you a much, much higher valuation, that's going to extend your borrowable equity, and that'll help you get into the next property and lock that equity in. So it's about hustling. It's about being strategic about revaluations and refinances. And I've got this sort of term that I say, well, borrow when you don't need it. That's the best time to borrow. Don't leave it to, I'm going to buy a property in 2 years, so I'm going to refinance in 18 months' time. That might be the best way to go, but it might not. If there's a whole bunch of really great, tight, comparable sales that support a much higher valuation of your property, refinance today and lock that equity in. You don't have to use the money. You can put it in redraw so you can access it any time, but lock it in because you never know. I remember a time around 07, 08, we did this for a client. The GFC hit and property values came off a little bit, and that client was able to use that money in a much more attractive market. So even though he had no intention of doing that, the fact that we just always increased his LVR to 80%, locked that money in, you just never know what's around the corner. So refinancing, again, isn't about the lower interest rate. That could be a good thing, but it's really about borrowing capacity because the scarce resource isn't property. And the scarce resource isn't investment grade property. Like if I had $10 million to put into the market today, I'm sure I'm going to find, or you guys on my behalf will find enough properties for me to buy over the next 1 to 2 years where I can deploy that $10 million. That's not the scarce resource. The scarce resource is the $10 million.
$10 million, yeah.
Is the access to borrowing capacity.
Yeah, that's really all about forward planning, isn't it? Because, I mean, forward planning can save you tens of thousands of dollars later. It's one of those things that it's an important step in the process, whereas step 2 in the first home buyer course is really just thinking about these things and thinking about the long term. Because, often they don't even realize it's a risk or it's an asset. The borrowing capacity themselves is an asset. They don't even think of that until it's too late. And I know myself, in my original, property journey, mistakes I made through just not understanding any of this stuff. So a lot of where I got to after I got older was good decisions. Before that, it was luck. We don't want that. So can we talk about online lenders, right? Because they're popping up everywhere. Are there any risks with using, online lenders that first home buyers should know about?
A lot of online lenders typically have quite restrictive credit policies and product types. And I think they suit a certain cohort of the market, but it's probably not active investors. And when I say active investors, that also includes first home buyers that are trying to get into the market and leapfrog to the next property. I would put them into that kettle of fish as well. So what they suit, those online lenders typically suit a scenario where mum and dad go and buy a house, they've got a mortgage, they're going to repay this mortgage over the next 15, 20 years, hopefully, and that's all they're ever going to do or ever want to do. An online lender, which is kind of the cheapest rate, is a perfect solution for them typically. But quite often there's going to be idiosyncrasies associated with these online lenders, or they'll only take into account 60% of rental income because they're not really geared to investors, or they've got, slightly tighter borrowing capacity, or they've got slightly tighter loan to value ratios. And they have to do that to try and streamline the credit approval process. They don't want really complex files. They don't want to have a file that kind of pushes the envelope a little bit in terms of borrowing capacity or situations. They typically don't suit a lot of clients. They typically, again, if you've got a loan and you're never going to do anything with that loan, they could be good for you, but, they're typically not in that market. What you want is like I said, a mortgage broker that's going to do all that work for you, that says, we're going to start with ANZ. In 9 months' time, we're going to revalue the property. In 2 years' time, we're going to refinance to CBA. In 4 years' time, we're going to go over to NAB. Whatever, Macquarie, whatever it might be. I would say personally, I'll probably refinance every 4 to 5 years, but I'm kind of, I was going to say end of my journey. I hope that's not true.
No, you're in consolidation.
More established, but if I'm a first home buyer just starting out, I'll probably refinance every couple of years. Not because that's what I really wanted to do, but it was circumstantial that, my property is increased in value and now my lender's not valuing it high enough and lender next door will. So bang, I'm out. I'm going to the lender next door and maximising my borrowing.
It's being active, being on top of it, just not set and forget.
Yeah, you've got to be. And I'm still doing that today. I probably haven't refinanced for a couple of years, and I imagine I can anticipate over the next couple of years I will. Again, it's just a game of finance. Who cares about the lender? Who really cares about the interest rate too much? It's really about letting me use my equity as powerfully as possible and being in control of, how much access to equity do I have and when I can then invest that equity.
It's making me think I'm being a bit lax in that area.
I've actually just bought another property, so I'm going through refinancing everything at the moment. And gosh, isn't that a tricky thing to go through? So look, I guess with those online lender options, it is a bit of a trade-off, isn't it? Because it might save you a little bit of time up front. It's easy, click a few buttons. If you fit within their box, you might find a quick tick. But you actually could lose a lot of your flexibility if your situation changes. And that's when it could actually be quite expensive.
Yeah, refinancing, internal refinances can be a bit harder and a bit more restrictive in terms of accessing equity, but I think it's guided by borrowing capacity, right? So if I had an online lender that was going to lend me $1 million and everyone else's borrowing capacity was 700,000, 800,000, I'm probably on board. And again, and I might not be there forever, they might not have many bells and whistles, their service might be crap. Someone said to me, you can have features, service or price. There's 3 options. You can only choose one of them. And so with those online lenders, you're probably going to get the price is okay. You're either going to take a haircut in features or service, but that's okay. Like the service might be terrible, but if it gets me into the market and maximizes my borrowing capacity, fantastic. But the probability is that's not going to be the case. And particularly, depending on your scenario, it's not like a one size fits all, depending on your income profile, whether you've got a casual element, whether you've got a variable component of your remuneration, whether you've changed jobs more recently, what sort of role that you're in, how much deposit you have, all these sorts of things will go to, this particular lender suits your circumstances best. So it's not really a one size fits all, but it does come down to borrowing capacity in my viewpoint.
You've beautifully segued into the next question. Thank you, Stuart. Why would you go to a broker instead of your bank?
Being a great broker is really about understanding the client, their current circumstances and their goals, so where they want to move in the future, and then matching those current circumstances with a lender that best suits them and accommodates what they need to do. That's really the outcome. And so what you don't have as an individual is understanding the idiosyncrasies in different credit policies and the different product parameters. And that's what you really need to understand. And then you need to be a little bit smarter than that in terms of using all those things to your favor. How can you structure an application to make the most of those different idiosyncrasies and changes? So not even a banker necessarily sitting in a branch will be able to do it. Maybe a broker will, or a really smart banker or a really smart broker will be able to achieve a better outcome with the same credit policies than certainly a layperson and certainly an average sort of banker or broker. So it's really about playing that game. It's really about understanding the rules and then playing those. It's much like Monopoly, right? You play the game, you understand the rules, and then you play the game and use those rules to your advantage. It's very much the same with lending. So you just don't have the knowledge and the experience. And remember, experience is critical too, because it tells us when and how to apply that knowledge. And, as an individual, you might apply for, or refinance, 10 times during your lifetime, maybe more. I don't know. As a mortgage broker, you're probably working on 10 different applications a day. So you're going to be better at it.
I guess it's like having an expert, assuming you've got a good broker, because there's a lot of them out there, right? So you got a smart broker who talks to you like this. They're in your corner rather than just going to the bank and having them just sell you whatever product they've got on the shelf, because they are limited in branch, or even the mobile lenders are all limited in what they've got to sell you. Last question, how can first home buyers then make themselves more attractive as mortgage customers? You talked about, a broker that can position the borrower. What should they be doing now to strengthen their position before they apply?
Find a fantastic broker. And then when you found that broker, follow their advice. I think from our perspective, there's nothing more frustrating than going, I understand your situation. I know exactly what you need to do. Go away and do A, B, C, and D. And they either don't do it or they do E and F as well and completely mess it up.
Like buying a new car. How many times have I heard someone who was ready to buy a house, they buy a new car and suddenly...
Lots of the different stories happen all the time, right? But that's the challenging thing for us. Let us help you. Your job is to find the best broker you can find. And then once you've found them, just follow their advice, I think. And they'll tell you what you need to do in your situation to strengthen your position. A really great broker will say, don't buy now. I can foresee in 6 months' time your borrowing capacity is going to be higher because of these changes that are coming by then. Other brokers, a great broker might say, buy today. You've got to get into the market before something changes. Whatever it is, they'll design a strategy that's going to suit you, particularly a broker that's really focused on a long-term relationship, because we know as brokers that if we help our client make a really smart decision, there's a lot we can do to help them because they're going to build equity. We can access that equity. If they make a really dumb decision in terms of buy the wrong property, get in the wrong point, whatever, there's not much we can do to help them because there's no equity, borrowing capacity is restricted. So it's in both our interests in terms of the lifetime value of a client and the actual client to make sure we help them make really smart decisions.
Such good advice. So practical as well. And I hope that all of you listening have got a lot out of this because, Stuart, of course, is going to say that the money is the most important thing and the asset selection might be secondary. We, on the other hand, of course, believe that the asset selection is incredibly important. But if you put the two things together in the right way, that is going to put you so much further on the ladder for your future. And it's about thinking it's long term. It's about that future, and having that right team at the start will absolutely put you on the right path. And honestly, if you get your finances and structure right before you buy, you'll be so far ahead of most buyers out there.
That's been incredibly valuable. There's been so much depth behind borrowing strategy. And look, we really have only scratched the surface. We do actually have a question that we ask every guest, which is, what do you know now that you wish you knew as a first home buyer?
To be more aggressive at borrowing capacity, which I think I mentioned, but there's been a number of times when I bought property thinking, oh my God, what have I done? That is so much money to borrow. I hope this is really going to work out, which kind of sounds really bad to say as a financial advisor and broker. But, we're all susceptible to the same kind of emotional
Well, it's
reaction.
big decisions, yeah.
Yeah, but looking back, I would have been probably more aggressive than what I was. Now, I don't know if it's going to change their outcomes dramatically, but that's something that I try and counsel. Even the upgrade, the second decision after you buy the initial property, I try and even counsel clients to do that because there's so many financial and non-financial benefits of really trying to get a better quality property. And it's true with first home buyers, it's really throughout your ownership perspective. And it always works out, which is not to say, just don't consider the numbers and don't worry about the risks. Of course, you've got to think about all those things and you can't be stupid about it. But that's the thing I would talk to myself at 20 years, 30 years ago. I'd say, look, be more aggressive.
Oh, look, I know
I know somebody sitting in this room who has this virtual room
studio.
who
I've
has
got
shared
the same
that story herself.
because I literally bought a studio apartment for my first. And I thought it was safe because it was small and it was cheap, but I didn't even explore. And I looked at the next suburb. I could have bought a little cottage in the next suburb. I just didn't push it. And if I did, my situation, it would have just set me off a lot better.
It absolutely is. And certainly for our listeners, if you're nodding along and sort of thinking, I need to sort this out properly before I go shopping for this house, this is a very important part and is step 2, as we mentioned earlier, money in the first home buyer course. So head over, check that out. Stuart, it has been an absolute pleasure having you on again, and we will have you on before 4 years next time.
Pleasure's all mine. Always enjoy the chat and good luck to everyone. Hopefully it's been worthwhile.
Too many first-home buyers are stressing themselves out and wasting money just by doing things in the wrong order. That's why we created the First Home Buyer course, a 10-module online course with weekly mentoring, where you'll learn exactly what to do and what not to do at every stage.
So instead of drowning in Google searches and random advice, you'll feel clear, you'll feel confident, and you'll feel in control. You'll get direct access to us so you can send through properties you're considering and we'll tell you if they're worth it. And we'll even help guide you through negotiations.
The course is $990 and honestly, it'll pay for itself because buying without the right guidance can cost you tens of thousands more than the course itself.
Quick note, you of course know that nothing in this podcast is to be taken as personal advice. We always recommend getting the advice of an expert in their field who takes the time to understand your personal situation. We've done our very best to ensure that the content is correct at the time of recording, but things change rapidly, so always check with the relevant government authority and your trusted advisors to get the most up-to-date information.
Thanks for joining us. If you've enjoyed this podcast, we encourage you to join our Facebook group. It's called Your First Home Buyer Guide Australia, and it's your opportunity to connect with us and ask us your questions, which we will answer, meaning you can make sure that you're not getting led down the garden path. We hope to see you there soon.